Everyone knows that investing in the stock market can be risky, but have you thought about how risk changes over time based on valuations? This is an important consideration that some people overlook. The fact of the matter is, the stock market, while always having some degree of risk associated with it, has risk that goes up and down depending on how expensive the stock market is. There is a real important thing that people often forget, and that is that the valuations can have a major impact on what your expected returns are going forward. Stated differently, the higher the valuations currently, the lower the expected return going forward. This is something that a lot of people, as I say, haven't really fully contemplated. They're very happy because they've gotten great returns in the stock market for the past number of years, and they extrapolate. They think that the recent past is a reasonable reflection of what they might expect going forward. In fact, there's a concept called reversion to the mean. Those things that go up the most in the recent past are the things that are likely to go up the least because everything goes back to a long-term trend line over time. One way of looking at this is using the cyclically adjusted price earnings ratio. This is work that was done by Nobel laureate Robert Shiller, and it won him the Nobel Prize in 2013. In it, Shiller showed that if you look at the historical price earnings ratio of any given market, adjusted for inflation over the previous decade, it provides an excellent proxy for what you might reasonably expect going forward for the next decade. And historically, when the CAPE ratio, the cyclically adjusted price earnings ratio, is in the mid-30s or higher, the return for any given asset class with a CAPE of 35 or higher tends to be close to zero for the next decade. Well, the S&P 500 has been between 35 and 40 or 41 for the past 6 years. And if you were to use that as a process for extrapolation, you could therefore say, well, if the market has gone up by, say, 50 or 60% over the past 6 years, which it has, or if it's doubled, I think it's actually doubled in the past 6 years, then that would be a reasonable rationale for having it drop by half over the next 4. Now, that doesn't mean that it's not a forecast. No one knows. But historically, the CAPE is a very good predictor of what you could expect over the next decade. And the CAPE was extremely high before people had ever heard the word COVID. In late 2019, the CAPE for the S&P 500 was already in the mid-30s. This is also important if you look at it from a financial planning perspective. FP Canada, the people who confer the CFP mark, have put out assumption guidelines every year in April, helping planners make their reasonable assumptions for projections going forward. And for the past number of years, they have been saying that the expected return for the next decade for Canadian and American stocks is between 6 and 7%. Going back to what I said earlier about regression to the mean, if the expected returns are 6 or 7%, and the past 5 or 6 or 7 years has been getting returns that are double digits, it just stands to reason that it's probable, but not certain, that the return over the next little while will be flat or negative. That's not a forecast. I'm going to say that for forever. I don't know what the future holds, but I do believe that there are many people who are going about their financial planning without giving proper consideration and full consideration to the risk they're taking by being in the stock market when valuations are this high. This has been Weekly Wealth Update, a Make Better Wealth Decisions podcast dedicated to explaining how current events impact your portfolio and the wealth decisions you make. Tune in for commentary on how the news of the week affects your portfolio and your thinking.